June headlines. Fed speak. Fed governor's out, Fed chair out, lots of talk.
A little bit of action in the yield curve in terms of flattening, which gave investors some hesitation towards things like the reflation trade, the value versus growth trade. But at this point, it looks like all talk. The fact of the matter is, if they were going to hike, this might be their best opportunity right now.
Yeah.
And they're talking about maybe hiking in 2023. And then they're talking about tapering, but they will taper as much as the market will allow them, and that's probably not a lot.
Next headline, reflation trade. Is it over? Is it paused? Maybe first, what is it?
Yeah, the reflation trade, some element of stimulus resulting in increased spending and the economic recovery being very strong and the economy reflating. Yeah. No, it is certainly not over. If you look at the level of household savings, consumer confidence, there is a tremendous amount of money sitting in consumers' pockets, and we have a spending mentality in the United States. We don't have much of a savings culture.
Brings up the next headline, inflation. Inflation. A lot of that narrative is cemented in the mainstream media, and the word transitory is associated with it.
The goods in the CPI basket that are tied to the reopening of the economy, those appear to be transitory. Those price increases appear to be transitory. The market seems to be fully on board with that. So the idea of runaway inflation above 4 or 5% like we're seeing right now, that continuing, unlikely. Market does not expect that. But what is also being cemented is the fact that longer term price increases that we're starting to see, things like housing prices, are going to filter through to CPI over at least the next 18 months. And so we should have inflation running solidly, slightly above 2% for the foreseeable future. So transitory spike, but then running at a higher level than we saw during prior economic cycles.
The value growth trade definitely paused in June.
Yep. Yeah, growth stocks in June really outperforming value stocks. We know value stocks have been leading the market higher basically since last September. Saw the pause this month, very much related to the flattening of the yield curve we saw as well. So the Fed talking, is the reflation trade over? The transitory inflation narrative being cemented in the market, all these things related to value versus growth. And in our view, this is really just a pause because as the spending continues, the economic recovery continues, we expect longer term interest rates should grind higher. And right along with that, value stocks should continue to outperform growth stocks.
And we're going to get a good indication of that as we see earnings come in. And today starts earnings season, and it's going to be probably one of the most historic earnings seasons ever.
Yeah.
Are we peaking, or is this something that we're going to see for a while?
Well, a year out from COVID, you would expect some pretty strong year-over-year numbers, right? But what we're seeing are the expectations for earnings this year and next year continue to move higher at a very rapid clip. Companies are generally beating these lofty expectations, and a lot of the beats and the fastest earnings growth are coming from the economically sensitive and more value-oriented sectors.
So one other big risk that we see is the Delta variant. It's been in the news, it's gaining strength. I think it's 26% of the cases here in the US now, 90 plus in the UK.
So the Delta variant is very transmissible, and it has paused some of the reopenings in foreign economies that are less vaccinated. It has absolutely ravaged places like India and the continent of Africa, which is very unfortunate, but vaccines do appear to be effective against it, which makes us very grateful that in the US we have a high enough vaccination rate that this most likely will not derail our reopening. It is something to monitor. This is exactly the type of thing that shows up in our outlook in the bear case scenario, variant risk, so we are monitoring it closely, but at this point, vaccines seem to be effective.
Yeah, it's been quite a month, and we're ready to turn the page. Let's get into the returns for the month for all the asset classes.
We'll take a look at the furthest left column, so those are asset class returns just for the month of June. And once again, green pretty much across the board. So the S&P 500 positive, Russell 2000 small caps positive, adding to their strong year-to-date gains. So the S&P 500 closing the first 6 months of the year up 15%, 15 and a quarter. So really strong first 6 months of a calendar year. Foreign equities for June, a bit of a mixed bag. Foreign developed market equities, represented by the EFI, slightly negative returns in US dollar terms, primarily two reasons. One, the Delta variant emerging and sort of pausing or rolling back some of the reopening there. And then two, the US dollar strengthening quite a bit, foreign currencies weakening, which reduces foreign equity returns for US investors. And then in the fixed income space, interest rates, particularly at the long end, continued to move down, which supported bond prices. So some positive returns across the bond market, and commodities just continued to move higher as well.
So any surprises inside these numbers that we're going to talk about?
Yeah, on surface level, not too surprising, right? Just like the other 5 months of the year. But underneath the hood, what we saw in US equities was growth outperforming value by the largest margin since March of last year. So value obviously has been outperforming growth by a historic margin. June was the opposite of that. So that was pretty interesting. And then within fixed income, yield curve didn't move that much, interest rates didn't move that much, but the slope of the yield curve changed quite a bit. It got much flatter, which typically is not a great thing in terms of future expectations for economic growth and inflation. So all the stuff under the hood really forces sort of a pause to reassess the trades that have done so well for the first 6 months and say, you know, is this a consolidation? Is this just a bit of a retracement? Or, you know, is it going to be a new playbook for the next half of the year?
A lot of stuff going on underneath the numbers that really, I think, are foretelling what the second half of the year is going to be.
Right. The big news during the month of June was the Fed's quarterly meeting. They came out with their dot plot, which should be taken with a huge grain of salt. And basically the collective wisdom or lack thereof of the Federal Open Market Committee suggested that by the end of 2023, the Fed should have hiked short-term interest rates maybe 2.5 times. And so that surprised the market somewhat. There was a reaction in the yield curve. And, you know, is this just talk or is there action actually going to come of it? And, you know, the Fed should be thinking about starting to hike rates. Will they get there? We don't know. But we're still a ways off, obviously. Right. But we throw up this chart just to show, if you take a much longer term perspective about what really matters here, the blue line is the federal funds rate. And what you see is a sequence of lower highs and lower lows. During each and every economic cycle since the 80s, the Fed has been able to hike rates less, and they've had to lower rates more. So, you know, what are we really debating here? How many rate hikes could the Fed possibly get to during this economic cycle?
Right.
If we're already basically at the point where economic growth may be its strongest, sort of year over year, inflation may be its highest year over year, and they're saying we might hike in 2 years. They might be missing their opportunity right now.
Right.
So from a longer term perspective, they can talk a lot right now. Will the market allow them to hike rates in 2023? Maybe, but meaningfully, probably not.
So do you think the talk really is more of a testing of the market to see how will the market react to the potential of rate hikes and tapering? Or is it just they need to say something in order to sort of show that this is not headed in a very bad place?
It's a lot of posturing. It's testing the market, one, and it's allowing the market to do the work for them is the other thing. So the market has already expected multiple rate hikes out in 2023. And you've seen that in short-term interest rates. You've seen that in the dollar getting stronger. Financial conditions generally starting to tighten. And so when the Fed sees that the market is already pricing in hikes, they're fine with that. The market effectively can tighten financial conditions for them. All they need to do is not upset that. So they pay some lip service to the market's expectations to reinforce those. And then what usually happens is they don't even need to hike because the market has done it for them. When it goes in reverse and the market prices in cuts, then the Fed has to meet the market with cuts immediately. But they're very happy to let the market price in hikes and do the tightening for them.
But we saw actually the yield curve, it flattened out a bit, right?
Right.
And the long end came down, which would suggest that perhaps there is no inflation.
Yeah. It certainly suggests that the transitory inflation narrative has taken root in the market. And the Fed perhaps made, Jerome Powell in particular, perhaps made one comment too many, saying that they are worried about inflation long-term running away. And that caused the yield curve to flatten. Some of those longer-term inflation expectations were already coming down. He didn't need to say anything. And then he said something, and they came down even more.
Right.
But they came down to an elevated level, which is key to dissecting this inflation narrative. What's transitory? What's the longer-term run rate? What does that mean for the economy, prices, et cetera?
Yeah, great. Let's move on to looking at the Fed assets.
Yeah.
Yeah.
So this is the exact opposite.
Exact opposite.
Of the federal funds rate. The other big headline was Jerome Powell said in the press conference that you can think of this meeting as the talking about tapering meeting. So they're talking about tapering. When we say tapering, we mean reducing the $120 billion of asset purchases every month. At some point, they're going to reduce it. The consensus is that they're going to start reducing it next year. And once again, taking a longer term perspective, look at this chart of Fed assets. What you see are higher highs and higher lows. The Fed is not going to be able to materially reduce the size of their balance sheet.
Right.
They are going to have to be a buyer of Treasury securities and mortgage-backed securities for the foreseeable future. The dynamics of the amount of new Treasury issuance that's going to come to market because of our deficit situation, the lack of consistent foreign buyers, and the fact that the banking system, the U.S. banking system, can buy some of these treasuries, but they're limited due to regulation in terms of how much they can buy, means by default, the Fed has to be a buyer. They can talk about how they're going to be less of a presence, but in order for monetary policy to work, the U.S. financial system to function properly, the government to be able to roll over its debt, they are going to have to keep growing the size of their balance sheet.
And so, higher highs, higher lows, how long?
I mean, I'm comfortable saying forever. Very comfortable saying that because there's historical precedent. I mean, just look at Japan.
Right.
Yeah.
Yeah. Okay. Let's move on to inflation and talk about the narrative that's in the market. And let's define transitory, because really transitory is just a term. There's no time frame associated with it. And if you step back from what's happening month over month, quarter over quarter, there are significant deflationary forces in the world that we're fighting. So transitory for a period of a year or 2 years probably isn't a problem, right?
Right. Yeah. So yeah, trying to dig through all that and also getting at the question, is the reflation trade dead? Sort of all in the same response. So if we look at inflation expectations, I think this speaks to a lot of what's going on. So the two lines we have on this chart, these are break-even inflation rates. This is what the bond market thinks inflation is going to be. So when you say 2-year inflation expectations, that's somewhat transitory, 1 to 2 years.
Yeah.
That's something that market participants, a lot of producers, they can look through that, hedge that out, whatever the case may be. 10-year, that's not transitory. So a few things to notice about this chart in terms of what the bond market is expecting of inflation. One, the lines are relatively high. They're both above 2%. They expect over 2% inflation over the next 2 years, 2.72 to be exact, and 2.3% over the next 10 years. So they're high. So even after we get through this transitory hump, which we think there will be a transitory spike and start to fade, you're still going to be running at inflation higher than the past economic cycle. The next thing you'll notice is that the 2-year is higher than the 10-year. This is disinflationary. This also speaks to the transitory nature. This is the collective wisdom of the bond market, which we have more faith in than when we say collective wisdom of the Federal Open Market Committee, but saying that inflation will be higher over the next 2 years than it is over the next 10 years because some of these cyclical factors that are driving up prices will abate as the economy reopens. And the last thing you'll notice is they've stopped going up. They flatlined and they even started going down. So the idea of runaway inflation is not priced in. And the market has become very comfortable with the idea of a transitory spike in inflation. So a lot of information in this chart and in what the bond market is pricing.
So not terrible news,
No.
not great news, but
yeah,
sort of as expected, maybe?
Yeah, very comfortable, very in line with the things we have been talking about for the past few months. So the market really getting on board.
When you dump $6 trillion into the economy, you would expect a little bit of this.
A little bit, but yeah, not bad.
So let's look at the components of CPI and show how they're trending.
Yeah, then you have to start to dig under the hood and see, does the bond market have it wrong? Can this transitory thing be a long-term thing? So this is a chart that a little different take on it from what we showed last month that a lot of viewers and clients really liked. So we've broken down the CPI basket into our own groups, and now we've shown them through time. So you have the commodities bucket, so commodities excluding food and energy. These things are included in core CPI. You see those are starting to go up, about 6.5% year over year, as expected. The reopening bucket of goods, things like used car prices, car and truck rentals, airline fares, hotels and motels, the things that are tied directly to the reopening of the economy, up significantly. These things appear transitory.
Right.
This is creating the big spike in inflation that we're experiencing right now. Those should fade.
And they're up because of the year-over-year comps, right?
Right. Huge part of it.
Right.
I mean, you literally shut the economy off and now are turning it back on. The year-over-year comparison is going to be tough. That we're comfortable with, the market's comfortable with. The big question now is, let's look at that longer-term bucket. Let's look at particularly, it's called rent of shelter in CPI, which is owner's equivalent rent and rent of your primary residence. Rents are in the CPI basket. And only up, about 2% year over year. And this, to some clients say, well, I hear you guys talk about the housing market. You throw a dart at a map of the United States and you'll land on a town where house prices are up 10% year over year, right? It seems like house prices are up everywhere. So how is this possible? Why isn't that flowing into CPI? And that's something we've done a lot of work on as well, because we think that's sort of the next leg of the inflationary story.
So let's talk about that. And specifically, we have seen prices rise, but the data's on a lag.
Right.
So we could be sitting here today already witnessing the peak in housing prices.
Yes.
So let's walk through this chart and talk about that.
Yeah, great point. So rent of shelter, 40% core CPI, huge chunk. This chart shows the individual rent of shelter components. You have owner's equivalent rent, consumer rent in the blues. And then the green is the Case-Shiller 20-city composite national average for housing prices, up 15% year over year. Huge increase in house prices. And what happens, how these dynamics work is the year-over-year increase in house prices over the next 18 months, about a third of them should bleed through into the CPI. So that's why we're not seeing a huge spike right now.
Right.
It is coming. It's baked in the cake, so to speak. It is coming. But what it's going to effectively do is put a floor under CPI for the next 18 months. This is a huge chunk of the CPI. It's 40%. And it's going to be up about 5%, a third of the house price increase. So it's going to put a nice floor under CPI and should allow CPI to run somewhere around 2%, 2 to 2.5% for at least the next 18 months. So after we get through this transitory spike, you have that to look forward to.
And so translate that into what will happen to people's rents?
So this is very interesting. So what you see is if you're paying rent, so you rent your primary residence, you should see rents start to go up naturally over the next 18 months. The other metric in the CPI called owner's equivalent rents, this is a survey-based measure, and basically you go out and you ask someone who owns their home, what would you rent it to someone for with no utilities and no furnishings? And the answer to that question doesn't change much month to month. Just because your house price went up doesn't mean now you're going to immediately rent it for more. It's more, well, I'm going to cover my mortgage, or I'm going to cover the carrying costs of the property, whatever the case may be. So that's sort of whatever people say it is. And that's why it has such a lagged effect and bleeds through over time. So if you are going to rent your primary residence and like you're trying to rent an apartment in New York right now, prices are going up.
So if prices go up 5-10% for rents,
yeah,
how do renters absorb that type of cost increase? That's an enormous burden on somebody. If you're paying an extra, it's almost an extra monthly rent payment.
Right. That's why these are the things that the Fed is more tuned into, because they're kind of unavoidable. If you have to rent and you have to pay higher rents, you either need to move or you need to cut spending somewhere else. That's basically it. You kind of have to make it happen.
Or get a higher paying job.
Exactly. So, as long as wage increases compensate for this.
Wage increases would have to be substantial.
Yeah. If they were to compensate for it, then it'd be fine, but that's unlikely.
Right.
Yeah. So
when will we start to see evidence of the impact of this? How long? We talking fall or sooner?
No, so already starting to see it in major metropolitan areas that are reopening. You see rents in places like the Bay Area, New York City, they're going up quite a bit right now. And it should continue to bleed through for at least the next 18 months. Yeah.
More to come there.
Yep.
Let's continue our theme of things going up.
Yeah.
Small businesses, prices definitely going up. Prices paid, prices received, all these great things.
Yep. Prices paid, prices received. This is the NFIB Small Business Survey, where they ask small businesses, are you currently raising prices? What percentage of respondents say that? Then are you planning to raise prices? And both of these are basically, this is going to scare some people, the highest number since the 70s.
Yeah.
Coming off of a very low base, right? And it's percentage of respondents saying they're planning on raising prices. A lot of folks are planning on raising prices year over year. Or relative to what's been happening, because the economy's reopening. So coming off of a very low base. But this is a chart that gets thrown around that, folks that are trying to draw analogies to what's happening now to, say, the 1970s when we were faced with the oil embargo. This is a scary chart, right? It brings up some bad memories.
Yeah.
What's not in here is the extent of the price increases, just that they're planning on raising them. So it's definitely something to continue to monitor. But once again, it reinforces our narrative that higher inflation for this cycle is basically here to stay. There should be a floor under prices.
For sure.
We should be able to run around 2%, but runaway inflation still seems unlikely.
Yeah. Inflation is definitely trending right now in an upward direction. It might flatten out, but it's going to be here for a bit.
Right, exactly.
All right, so let's move on to another interesting statistic. We looked at consumer confidence and savings and how that translates into spending. Mm-hmm. There's a pretty big buildup of savings here for all this confidence. Right,
yeah, definitely. And this also speaks to the reflation trade. I mean, reflation, if you literally Google the definition, it always contains something related to, there's been a tremendous amount of stimulus that results in increased spending and the economy reflates.
Right.
And this is the chart. You have consumer confidence, current conditions, extremely high. So the third highest level since going back to the 80s. And typically when consumers are very confident in current conditions, what you see is savings have already been depleted. Mm-hmm. I've already spent all my money. Right. But this time around, it's different. Consumers have very elevated savings while they're confident in current conditions. Haven't really seen anything like this before, but you know what the outcome is going to be. They're going to spend the savings. Right. I mean, if you're that confident, you're going to spend down your savings, and that's a lot of money to spend down. We're talking about $4 trillion in savings that should be spent down, a quarter of GDP thereabouts.
And that's why I would maybe you can talk more about it, like one of the main reasons we think reflation really is going to continue.
That's exactly right, because the spending is just sitting in consumers' wallets.
Right. So just different than what happened in Japan where they save it all.
Right.
Here, we just spend it.
Yes.
So we have more fun here.
Yeah.
And talk about expectation in terms of how long it will take to spend this and what the sort of glide path is for getting this spent down to average levels, which are around 6%.
Yeah, so in the US, as you're saying, we have a spending culture, and so we expect this will be spent down relatively quickly. If you look at, we're starting to see consensus economic growth projections come in, not only for next year, but now 2023. Those imply that basically these are going to get spent over the next 12 to 18 months. So that means this year, consensus now for economic growth is somewhere around 7%. Next year, consensus is 4.5%. And then 2023, it's something like 3%. Real growth.
Real growth.
So you think about those numbers, you think of all this money that's saved, the reflation trade is alive and well. To think that we're going to have that level of growth and spending for that extended a period of time, and the 10-year treasury yield is at 1.5%, those things don't necessarily reconcile.
They sure do not.
Longer term interest rates should probably drift up in that type of an environment.
All right. So let's, topic we mentioned at the beginning was the value versus growth and how that relates to reflation. And this chart's really great. Our research team did a great job with this. So explain what's going on here.
Yeah, the blue line is small cap value stocks versus large cap growth stocks. And this is since September 1st, 2020. So what you see is this ratio sort of peaked out in March, where small value stocks had outperformed large growth stocks by about 60%, 60. And since then it has flatlined. And the red line that almost lays right on top of it is a measure of the steepness of the yield curve. So that's the yield on the 30-year treasury minus the yield on the 2-year treasury. And so when the economy is reflating, the yield curve is steepening, and value stocks, more economically sensitive type stocks, have been outperforming growth stocks. And when the reverse of that happens, so we've been in, the yield curve has been flattening really since about April, you see value stocks have really flattened out versus growth stocks. And so this relationship, this is in a lot of folks' quantitative models. They take cues from the yield curve, and then that's how they determine their equity positioning. Once again, you think about the potential spending, the economic growth, the fact that inflation should be cemented probably above 2% even after we get over this transitory hump. The yield curve should steepen from here. The 10-year, 30-year treasury yield, they probably have room to go up. And so what would happen to value versus growth?
So we're kind of consolidating perhaps here, and we should be going in that direction.
Exactly, yeah. So it seems to make sense that, yeah, we're consolidating, but as these factors play out, value should reemerge and rally relative to growth.
Awesome. So let's look at earnings season. Because all indications are it's going to be a crazy good, way above expectations.
Yeah, definitely. This is a chart we've looked at before. So these are S&P 500 earnings growth expectations. This is when expectations for the full calendar year were struck at the beginning of the year versus right now. So it's the light blue and the dark blue. And then we do the math for you, how much they've changed in sort of that gray shaded area. And all year, expectations for earnings growth in 2021 have been going up. It's been absolutely relentless. It's been right in line with expectations for growth. And it's been predominantly driven by the economically sensitive sectors. So expectations now are very high for the full calendar year because we expect more earnings growth in the back half. So 35% earnings growth now is the consensus expectation for the S&P. And then you look at things like materials, industrials, financials, earnings very high. And sort of the next leg of this, we know this is all fueled by the reflation trade primarily. You see consumer discretionary doing very well also. But the next part of it is now buybacks are going to be, for a while there, buybacks weren't necessarily politically or socially acceptable given everything that was going on in the world, probably for good reason. But now a lot of the primary dealer, big money center banks have passed their stress tests and they are ready to buy back stock and pay dividends. Mm-hmm. And stock buybacks, obviously, through financial engineering, increase earnings per share.
Right.
So
as an outcome of this, how much of this do we think is priced in to stocks right now? And would we expect, if this is the peak mm-hmm. for the foreseeable future in earnings, what happens to the stock market?
Yeah. Don't expect that. Well, if this is the peak, then we would expect a plateau. Because if you look at earnings expectations for next year, they're very solid as well. And also we pay a lot of attention to the rate of change in expectations. And the expectations just keep going up. So, if these earnings were just to be realized, that would do a lot for TINA. There is no alternative. Earnings yields are going to be going up, and they're going to look very attractive relative to fixed income if this materializes for the foreseeable future. And so that's going to drive investors begrudgingly, maybe, into stocks over bonds.
All right, so let's quickly hit on a few things that could derail this. Mm-hmm. Primarily the Delta variant.
Yeah, the variant alphabet soup. So COVID-19 variants we've outlined here: alpha, beta, gamma, delta, epsilon, and iota. And the Delta variant is the one that is causing some serious concern. So the Delta variant started in India. Now it is believed to be the dominant variant in the UK and is, really having a significant impact on places like Africa right now. And so creates a lot of concern. As we look at all these variants, one thing that is true is each new variant is more transmissible than the prior variant, generally speaking. Haven't yet to have a variant that is meaningfully more deadly.
They're usually not.
Right. Exactly. Yeah. Those two things sort of go hand in hand. If it's more transmissible, it's generally the same or less deadly.
Correct.
And we also haven't seen a variant come out yet that vaccines are not effective against. Full dose of a vaccine. Johnson & Johnson, Pfizer, or Moderna in particular. So all these things definitely create concerns for countries outside of the U.S. that are far less vaccinated. Talk about the entire continent of Africa, for example, less than 1% of the population is vaccinated, and they're in their third wave of COVID that they've mm-hmm. been fighting for a year and a half and can't even vaccinate frontline healthcare workers. And so obviously that's a health and humanitarian crisis, and it's going to be very difficult. And certainly the tourism industry there is going to be on hold for a very long time.
Absolutely.
But the more developed economies that have higher vaccination rates, this should not derail the reopening meaningfully. Some economies in Europe have had to reinforce mask mandates, stall the reopening. Los Angeles County reinforced mask mandates because of the Delta variant.
Yeah.
But the solution at the end of the day is vaccinations.
Yeah, we're somewhere around 26% of cases in the U.S. are Delta variant.
Right.
I guess the unknown is how we take this into the flu season,
right?
The fall, and that's really where we might see a reaction, because as of right now, it doesn't seem to be. The market is noting it, but doesn't mm-hmm. seem that concerned.
Yeah, that's right. This that and that coincides with the back to school season. Mm-hmm. So if the Delta variant meets a less vaccinated population, such as children, and it causes case counts to rise and folks need to stay home, more remote learning, that can put a damper on the jobs recovery if folks have to stay home. So there are definitely risks as we get towards the back half of the year, but vaccines seem to be the answer.
Any updates to our outlook as we turn the page here on the first half of the year?
Well, we are rapidly approaching the S&P 500 price target in the bull case, which was 4,400. As we shoot here today, we're somewhere around 4,300.
Knocking on the door,
on the S&P 500. So we still think that is now the highest probability. And although it may seem like there's not a lot of upside for the S&P 500, for example, our year-end price target for the 10-year yield is 2% in the bull case. And so what this is sort of setting up for is if longer-term interest rates start to rise as the reflation trade comes back into view, you could get the S&P 500 sort of moving sideways or grinding higher, but having value stocks significantly outperforming growth stocks. So there's still plenty of opportunities in the bull case.
And if we hit 4,400, we don't just pack up shop and go home for the year. Like it could go well above that.
Right.
Yeah. Well, that's a great update. Thanks for joining us. And thanks to the research team here at CAP STRAT for putting together some great charts for us. And we'll see you next month.